If you're interested in how highly successful investors overcome limitations and become unstoppable forces of success, you're in the right place. The Conscious Investor Podcast features weekly conversations with real estate investing experts and delivers a Monday Mindset episode to help launch your week with intention. If you believe success is for everyone willing to think, then do, these conversations will be your weekly rocket fuel. Conscious investors, welcome back. This is coming full circle right now with this episode with Rod Khleif. Rod, you know, because I've told you, I've written you cards, I've done so much to let you know the role you've played in my life. And just a reminder to those of you who are new listeners to the show, man, Rod is part of the genesis of this podcast way back when it was originally Ask Me How I Know. That was from Rod. And everything that I've ever gained in the multifamily syndication space, this is one of those tentacles where it's like Rod is part of that cornerstone foundation of my journey. So it is always a joy to have you around, Rod, and you bring so much value to everyone around you. So I just want to say thank you for the role you've played in my life, and let's do this. I'm so happy. Welcome.
Thanks for having me back. Let's have some fun today. I'm still upset about the fact that you changed the name, but
I know.
yeah, you know, it's funny that Ask Me How I Know thing. If you don't know the story behind that, at my boot camps, I would, I've made every mistake you could possibly make. And so I would say, don't do that. Ask me how I know. And so much to the point that one of my warriors, Eric, got me a shirt that says hashtag Ask Me How I Know. And we were actually selling those shirts at the boot camp. So, it's just an awesome title. It really goes back to, and this is what really just every time, people ask me, Rod, they'll be like, oh, you're in Rod's group, you're in this. And I'm like, yeah. And, they ask me questions about you. I'm like, oh my gosh, he is the most generous, kind person. Let me tell you, when I wanted to title my show, Ask Me How I Know, and I sent this email that was just, hey, would you mind? And it wasn't like, sure. I mean, the whole energy that came from that email was, and if I read it back today, it's like, yeah, I'm so honored you'd even consider that. Yes, do this. And how else can I help you? Can I be a guest on your show? How else can I support you? And I mean, it was just for somebody that was completely new to this space and new to your world and just so green. It was like, oh my gosh, this is such a gift. So amazing. Oh, thank you. Thank you. So let's add some value today. Let's see what we can do to rock this place.
Well, let's totally rock this because everything is about ready to really rock. And as Rod and I were talking off air, and asking him like, hey, can we just talk about the coming recession? Because it's coming. And you know what? For anybody that is in denial or scared, one, it's not the first time there's been a recession. It's normal. It's an economic thing. So let's talk about this and let's help people, maybe because you and I are in agreement that fear is not where growth happens. Fear will inhibit you. So let's take people from fear and all of that to abundance and opportunity.
Yeah. Well, let's back up and just,
Sure.
I'm going to tell you that it's not Julie and I saying there's going to be a recession. I mean, the former CEO of Goldman Sachs says we're to hire, Lloyd Blankfein said that we're definitely heading into a recession. Deutsche Bank, Bank of America have also said we're heading into a recession, not the least of, which is, we've got the geopolitical uncertainty around the war in Ukraine, which has made the fuel, well, they say that's been the reason the fuel prices have gone up, but we won't go down that political rabbit hole as to what else has caused fuel prices to go up. But, that's all pressuring things. And, and I'm going to tell you, for the first time in a long time, we've seen an inversion in the yield curve between the 2-year and the 10-year U.S. Treasury bonds, which literally has preceded most recessions in the past. And, really, what is a recession? It's typically 2 quarters of negative economic growth. And, and it can be triggered by all sorts of things like that, a financial, like the COVID could have done it. It didn't, but there can be, that can be a factor. It can be an external trade shock because of issues like we're having with China right now with, they're shut down and ships aren't coming over, supply chain issues, it can be the burst of an economic bubble. And I really believe that we have been frothing for quite a bit now. I mean, look at some of what's happening, with pricing in this country, or what's happened in the past with, in our business, and, what properties are trading for. But, basically in the US, a recession is defined as a significant decline in economic activity lasting more than a few months. And, and they're really a natural thing. They're considered a natural part of, our business and economic cycles of expansion and contraction. And, so, I'm going to say this, I believe there is a recession. I'm certain that a recession is going to happen if we're not already in it. Okay, number one. But a deep recession is what's called a depression, and like the Great Depression we had in the 1900s, which lasted several years and saw a GDP decline in excess of 10% and unemployment over 25% and so on and so forth. And here's why I don't believe we're going to have any sort of major issue. First of all, the labor market is extremely healthy. I mean, people are clamoring to find workers, and the minimum wage is much higher than it's ever been. I mean, geez, there's people. Amazon's hiring people $18 an hour. Hobby Lobby is advertising for people at $18 an hour. So, economic growth may decelerate, but you have to slow that down. That's the only way to fight inflation. And so we're going to see some rate increases. We saw 50 basis point rate increase. What was it, last week or the week before? And that's definitely going to start, there's going to be more of that. And there has to be. It's going to slow things down. But I really believe this next recession is going to be kind of a mini compared to the last two. And it's going to feel different because Americans' finances are in much better shape. So, the growth will likely only slow. And, and really economists across the board are saying that for the first time since the early 1990s, we're on track for a fairly normal recession, and it seems like the spending is really up there. I mean, the demand for products with Americans is still very, very high, and it doesn't look like consumers have overextended themselves like they've done in the past. But I think as we go into recession, it's not going to be a serious, massive downturn, but there's going to be a slowdown, and it should bring some stability to the employment side of things as well. And I think that what's going to benefit from this recession is the service industry for sure. Okay, people are eager to get back out there and travel and so on and so forth, but I don't think like all the things that they've been buying because of the stimulus checks and everything else, like cars and furniture and clothes and all that, I think that's going to slow down. But service and travel and theater, bars, transportation, things like that should thrive through this. Lodging, travel, all that's going to continue to decline. But here's the risk, okay? And here's what's going to dictate how severe it is, and it's just going to be the Fed. How aggressive are they with the interest rates? And can they really kind of ease into this thing? Because that 50 basis point, they're talking about 50 basis point increases, and which is significant. So they've got a hard task to get through to weaken this demand and not have a nosedive in spending. And so, because if spending nosedives, then employment, we're going to start seeing people laid off and things of that nature. And then economic growth really, really tanks. So, how do they raise it enough where it slows things down, but it doesn't scare people enough to stop spending? But for consumers, those rate hikes are going to lift costs and borrowing for, mortgages, of course, car loans, credit card debt, things like that. And the other thing to remember is there's typically about a 6 to 12 month lag, because where it won't really have an impact for about 6 to 12 months. And that means, people are going to have to contend with these rising interest rates and faster than usual increases in the price of things. Because of the strong the households being stronger than normal, their balance sheets are stronger. I think spending is going to keep growing. I think we're going to continue to see economic growth. But now let's get to what's really important, and that is you're in the right freaking place as far as inflation and a recession. There's nothing better than multifamily, and with crisis comes opportunity. And I don't think there's going to be a crisis, but I know there's going to be opportunity, okay, in the multifamily space. Why? Because we've become a renter nation. People can't afford to buy homes like they were in the past, and so they have to rent. and rents are not going down. In fact, we have seen incredible rent increases, like in the 20% range in many parts of the country and more, and the good thing about it is minimum incomes have also increased that correlate with those rent increases. So as everything else goes up, so do rents, which is why you're in the right place. And this goes to both passive investors and active investors. They're all going to benefit from this. And I could keep going, but I should let you say something, I suppose.
Yes. All this is so true. It is interesting to see what you were mentioning about the interest rates. I mean, the Fed has so much control just within different forms. My husband Steve's in the residential space, and he stayed there, and bless his heart, I love what I do. Right. But I mean, just within that space, people have kind of tapered off. It's like, oh, the rates went up, and it was this whole forum that I was reading through a thread, and I'm like, wow, lots of people are feeling, and that was just a little, I mean, it felt like a big difference, a big raise, but it really wasn't. Man, remember when interest rates, my first interest rate was like 6.888 or maybe 7.25.
My first one was a steal. My first one was 18%. Okay. That was the interest rate when I first started buying houses. I put houses on credit cards at 18% because the number still made sense. I could buy them for 2% of what I could rent them for. I could rent them for 2% of what I bought them for. Bought a place for 20 grand, could rent it for $400, which, there was just, there were a few years of that. But I remember doing backflips when it was 7%, going, oh my God, can you believe it's down to 7%? So listen, we have had it really good for a very long time. Now, here's another thing, that I get asked is, are cap rates going to increase with interest rates? And traditionally they do, but there are a lot of things that could mitigate that. And really what it is it's the spread between the interest rates and the cap rate that sometimes remains fairly constant, but sometimes there's big gaps and sometimes there's compression. And a lot of people think there's going to be compression between interest rates and cap rates because of the things I just said. We become a renter nation. There's, pent up demand for housing as well, huge pent up demand. There's a lot of money out there right now. Typically when there's real issues with pricing is when capital dries up, like it did in the first part of the 08-09 crash. It was hard to find capital, both debt and equity. But now, and then, the other thing is the volatility in the stock market. I mean, God, I feel sorry for those people that were in crypto in the stock market. I mean, they just, I saw some guy crying that lost $2 million, literally crying on a TikTok video the other day. I mean, it's been really, really rough. And so, because there's so much money that wants to get into this business, both passively and actively, it's got to affect, it's got to continue to affect pricing. But I will say this though, we were in best and final on an asset here in Florida. I'm not going to say where, because I think we may put it under contract tomorrow, but we were at like 42 million, and we just came back and said, no, we got to come in at 38. And they just told us to write the LOI again, that we might have a shot at it. $4 million decrease on an asset, literally in 2 weeks. Painful for the seller, even painful for us, because right now, we've got to be very, very careful on lending, because most of the debt right now is bridge financing, which is adjustable rate and can be very dangerous if not handled correctly. So, there is that. But again, there are going to be a lot of people that have to sell as things pull back. And so there'll be opportunity.
What do you think when I think about the people that will be in the position to have to sell? And let me just back up a second. We were best and final on a $32 million asset, and we couldn't. They wanted us to go up, and we're like, it's one of those things. Yeah. I mean, this isn't a time. So that will be a question in just a moment. Like, I'd love to hear your thoughts on overpaying, because I'm not into overpaying, but I've heard some people, and you know what, to each his own, but I'm responsible to my investors for protecting and growing their wealth, not putting it in and this might
putting them at risk, putting their investment at risk. Yeah. And there's a lot of that going on. I'm just going to tell you right now, I see what some of these properties are trading for, and somebody is BSing somebody. I'm just going to tell you, those pro formas have been manipulated to look good, or they're just incompetent, and they're not properly assessing the potential lending risk. Because if they're underwriting these deals at today's interest rate and they're not stress testing them at 6% through the duration, big mistake, because the Fed's going to do, they're saying 5 more rate increases this year. I mean, it's huge. Maybe not this year, but 5 more total. And so that's huge. And so, it's very, very important to make sure that you're stress testing your deals. And we're doing, additional operating reserves. We're doubling our operating reserves. Typically, we'll do 6 months of expenses and in just a what hit the fan fund, and we've doubled it. And so so that's one thing. And then again, massive stress test on and you may get the rent increases, you may not as well. You better look at that too. What happens if the rent increases stall out for a couple of years, which is very possible in a recession. So you just have to be careful. And I've seen some of these deals trade, and I know some of these people. They're not students, thank God, but I know some of these people that are buying this stuff, and I'm like, somebody is getting over on somebody, because these returns they're claiming, there's no freaking way, no way, impossible. Right. So and without a recession, there's no way, and then we've got a looming recession. But again, listen, guys, those of you listening, this is not a recession, is not something to fear, frankly. In our business, something to get excited about, get ready for. Like I'm in a lot of cash right now, and I've got access to cash. I've been pre-framing my investors. We're getting ready. And I hate the expression, but when the blood's running in the streets, that's when we really get going here. And there will be exponential opportunities in this business for the people that are prepared. And let me mention this: if you're thinking about learning this business, for God's sakes, come see me in Denver the end of July. I've got my only live 3-day boot camp of the year is in July in Denver. Should be about 1,000 people there, on 29th, 30th, and 31st. Can I give people the information on that?
Yes,
Julie?
Yes,
okay.
Yes, 100 million%.
Okay, so if you're interested, text my name Rod to 72345, and you'll get the link to multifamilybootcamp.com. And it's 3 days, not a sales pitch. It's not at all a sales pitch. I talk about my coaching for maybe 30 minutes. The rest of the 3 days is all full on training. And even that 30 minutes is not salesy. But the point is, it's drinking through a fire hose, though, as you can attest, Julie, you've been. Yes. And, you'll and the networking is off the hook. I mean, there's more going on outside the room than there is inside the room. And, but we go through every aspect of the business, from finding deals to evaluating those deals to underwriting those deals to the financing them. We have a loan broker doing the financing, a great loan broker. I've got a great SEC attorney talking about syndication, teaching that. I have 3 panels a day with, somewhere between $2 and $3 billion, and, represented by the panelists to answer questions. And of course, if you know me, I'm going to spend time on mindset. There's a reason my students are somewhere in the 60 to 70,000 units owned range right now that we know of. And I've only been teaching 4.5 years. I'm super proud of that. And it's because they take action with what they learn. And so, if you can come, please. Oh, by the way, remember this. I'll throw this out because it's you, Julie. We've got a special right now. If you use the word bonus when you check out, you'll get my document library and my deal evaluator software as a bonus. So it's $197 right now. If the price has gone up, it'll go up to $700 ultimately. If the price has gone up, just DM me and I'll make sure, and you just mention Julie, and I'll make sure you get that $197 price. But remember, text Rod to 72345, and then remember the code bonus. You come for $197 for 3 days of training. Kind of a duh. I mean, if you're serious about this business, both actively or passively. Yes. Even if you're going to be passively investing with Julie or whatever, then you should come, because, not in Julie's case, but you got to know who you're dealing with and understand, at least have some basic understanding of the business. Don't give your hard-earned money to someone unless you have some understanding. It always makes me crazy when I see these people that'll give millions of dollars to a stockbroker that knows how to sell, but hasn't got a clue about what's going on in the markets. And there are some, we just talked about some operators that are either clueless or nefarious, one of the two, that are overpaying for these properties. And, we're going to be standing in the wings to hopefully, not hopefully, I feel bad if anybody loses a property, but I think there's going to be some opportunity for sure coming. So anyway, would love to see you in Denver if you can make it.
And if you haven't already booked your booked a flight, booked your just make this happen ASAP. I'll never forget this right here, boot camp, completely 180 for my life and for my investing.
Oh,
And
thanks.
Rod, there are a lot of programs out there, but you were the program where I'm like, oh my gosh, I can learn from you and from the people that are aligned in the program. I've got this amazing, just a group of people that are in the program. So you're already in this group of like-minded people. And then on top of that, you have the mindset. And you were the first person I ever saw that put mindset and real estate together. And that was like, sold, done, you're awesome. And that high performance training, I still meet with my high performance coach to this day, and have partnered on different occasions to create different, content pieces for people. And, it's just, this is where the magic happens. And it's the caliber of people that are attracted to your boot camps. It's just exceptional. And so it's definitely not something anyone should miss out on. And I cannot believe, come on, people, most events are like, really seriously at least $700-800. So you are giving it away, but that just falls in line with the generous, you have a generous heart and you want the best for people. It's like $197, you guys, that's like handing you a ticket to an event. It's such a
it's more about the travel and the time, and I get that, but trust me, let me say this to you. You come to my event and you spend the 3 days with me and you don't love it. I don't mean like it, I mean freaking love it. If you don't love it, let me know, I'll give you your money back. It's never happened, but there's a first time for everything. Yeah, if you go to that website and go to the bottom, you'll see what hundreds of people have said about the event. Of course, Julie as well. But we have a lot of fun. You will cry, you will laugh. It's not your typical real estate boot camp because I need to push you to actually take action with what you learn. So I spend time on that because it's so important. And and like I said, my warriors, my coaching students like Julia, we've got 60, 70,000 doors, and most of them done between warriors as well. There's connections you make in the. And whether you do it with me or not, get in groups like that, because that's how you grow. That's how that's how you bounce ideas off each other. You make things happen that are just, that you can't do on your own. So, yeah.
Oh, that's amazing. Rod, we're going to need to wrap up here in just a moment, but I want to touch on overpaying and your concept of what would you say overpaying is, because there are so many changes. Inflation is real. Interest rates are real. There's so many different elements here that are pushing and pulling. And so what would you say, to someone who feels justified in overpaying?
Well, I would say you're taking a big risk where we are in the market cycle, because we are going to have a recession. We just talked about it. This is no question in my mind. It's got to happen because they've got to curb inflation, and that's again, it's a normal market cycle. But if you do overpay and you're banking on rent increases and you don't get those rent increases. And I've seen some deals that we penciled out where they don't even break even the first year unless those rent increases happen, literally break even, forget, returns, then you are at big risk. And so, you've got to stress test your deal. You've got to stress test the interest rates. You've got to stress test the rents, and just, be conservative right now. Don't be aggressive, be conservative. That's the name of the game. In fact, we had a special warrior coaching call a week ago on that very topic about bridge debt and how you need to be super careful right now because of the rate increases and the upcoming additional rate increases. And then again, operating reserves. I've seen deals where I've watched a presentation and I ask, what are you putting aside for operating reserves? And there's crickets, nothing. Are you kidding me? You couldn't handle it. You couldn't handle a single speed bump. And so, I want to make sure that no matter what happens, I've got enough money to make sure these, my investments are secure. And it's been a gravy train. Rents have gone up like crazy. We just had, just had a call on one of my assets in San Antonio, and we striped and numbered the parking spaces, and we had 75 people take a parking space at $25 a piece, which is a 740,000 instant increase in value. Which is why we love this business. But there are, you cannot be super aggressive right now. You have to be conservative. You have to pull back, and sellers are starting to see that. It appears it's painful for them because they to move just a little quicker, they would have been able to capitalize on the lower rates. Right. but it is starting to affect values for sure. Thank God.
That's really good. Yeah. Oh my gosh. Thank God. Yeah.
Right.
So passive investors that are listening right now, they're saying, okay, when I'm reviewing the next deal that comes across my plate, because I'm ready to invest, I'm going to be making sure they have operating reserves. I'm going to make sure that their rent projections are.
Ask them how they stress tested. Ask them how they stress tested the deal. By the way, I've got a resource for you if you're passive. If you text GP questions to 72345, I've got a list of questions that you should ask an operator before you do business with them. And it's just, a lot of it's common sense, but hang on. Yeah, questions to ask a general partner in a syndication before investing. There's about 50 or 60 questions in here, that are important to ask. I mean, you need to find out, a lot of pieces of this, things like there it is right there. Do you hold an operating reserve for this property? How much? Why'd you choose this market and this property? Why the submarket? What CPA firm are you working with? What syndication law firm are you working with? When and how will I expect financial reports? Have you ever had a deal go sideways? What happened? What kind, what's the preferred return? Waterfall splits? Are there any hurdles? Do you have any larger investors in this deal? On and on. What's your CapEx budget? Is any of it for deferred maintenance? Again, so if you want that, just text GP questions to 72345. It's a free download that'll help you, additionally help you. But if you're serious about putting hard-earned money towards this, for God's sakes, come see me in Denver. You'll be so glad you did.
And you'll love everyone. Such a great seriously, it's like a family reunion. That's how I feel. That's how I view the boot camps. Like, you're not going to go to the family reunion? Like, come on. Everyone needs to go. Yeah. Oh my goodness. Rod, I'm so grateful for your time. I know that you are insanely busy, and it's just always a pleasure and joy to just be able to feature your voice and your perspective, and I
wouldn't miss an opportunity to spend some time with you for anything, Julie. So you guys, you're in the right place listening to this rock star. So it's great to see you, sweetie.
So great to see you too. Rod, what's the best way? I mean, we've given some great resources throughout, and I'm going to see everybody in Denver the last weekend of Denver. Make sure you're there. But any other ways?
I've got we just came up with this today. So I've got this link tree that's got it's got my free books. Yeah. So if you just, and in this, by the time this goes out, it should be done today. So we'll be fine. So it's rodslinks.com. rodslinks.com, and that's got my website, my podcast, my free books that are there, and the boot camp website, and just everything you can need. I'm so glad you said that. My team's like, start using Rod's links, Rod. So here you go. I'm so glad you asked me. So forget. Yeah.
You had that same problem, because somebody sent me a message. They're like, you have way too many things on your link tree. I'm like, sorry, I have a lot of things to offer people. Like,
somebody you can't make anybody happy. I mean, I've got a lot of free resources. Sorry.
Yeah, exactly. Sorry. I love to serve people. So sorry.
Right.
Oh my gosh. Anyway, so make sure all of those are going to be in the show notes. So if you're listening and you're driving or whatever, the gig, it's in the show notes. You're going to be able to access it so that you can be safe, and you can also get all the information that you want. So Rod, I just want to thank you again. Thanks for being awesome. Thanks for your contribution in my life, which has trickled down into my family and my listeners and everyone. I'm like, it's that ripple effect that is you're like a boulder. Actually, you're probably more like a meteorite that came from outer space. It's just whoosh. It's just that's a high compliment, because I talk about the ripple effect so often. So
thank you.
All right. If you're not following Rod already, make sure you're following him on all the social platforms, because he goes live all the time, and he's always just adding value to everybody.
Thanks, Julie.
Okay. Until next time, amazing conscious investors, live big and love even bigger. What's the big deal about investing in apartments? Why is it better than investing in a slew of single-family homes? I've compiled a lot of information on why investing in a multifamily, also known as apartments, will help you reach your investment goals. Head over to 3keysinvestments.com and download the Why Invest in Multifamily guide today.